Have you ever wondered why your 30-year mortgage seems to barely budge, even after years of payments? What most people don't realize is that the traditional 30-year fixed mortgage, it was designed nearly a century ago. And guess what? It hasn't changed much since then. What happens next, it might surprise you. There is a modern alternative that flips the script on your mortgage and could save you tens, if not hundreds of thousands of dollars. Stay tuned because this could change the way that you think about home loans forever. Because I know that you think about home loans every single day, but rethinking your mortgage decision, it could be a game changer. Let's talk about the 30-year fixed mortgage that you either have or you have considered. On the surface, it seems safe and familiar. A steady payment for 30 years, and then you're free and clear. But what most people don't realize is that this safe choice might be costing you more than you know. Have you noticed that in the first several years, your balance, it barely moves down? That's because with traditional loans, lenders, they front load the interest costs. In fact, on a typical 30-year mortgage, over half of your payments in the first 5 to 10 years go straight to interest, not principal. You could pay $100,000 in payments over 5 years and find you've only knocked off about $44,000 from your loan amount. The rest, $56,000, it all went to interest. Ouch. Now, think about your own situation. Are you comfortable paying mostly interest for the first decade of your loan? Have you ever wondered if there was a better way to build equity faster? Most of us, well, we just accept that this is how mortgages work. But what happens next, it might surprise you. There is a better way, and the banks won't be the ones to tell you about it. The conventional mortgage trap. This is a trap that most people get into. Traditional mortgages, they have 4 huge flaws that can keep you trapped in debt longer than necessary. First thing is front-loaded interest. It's what we've mentioned already. You pay interest first and principal later. This keeps you in debt longer, and guess what? It maximizes interest costs for the bank. What banks don't want you to know is this structure is great for them and not so great for you. Number 2, inflexible payment structures. Your monthly mortgage payment, it's great. It's fixed for 30 years. But even if you pay extra towards your principal, your required payment does not drop the next month. There's no automatic adjustment or reward for your progress of paying down your loan. The only way to lower that payment is to refinance into a new 30-year loan, which starts the clock all over again at the most expensive point of your loan. And most people refinance repeatedly. They're chasing lower payments or lower rates. But at the end of the day, they add up in more total interest over the years. Number 3, mortgage prison for your money. A traditional mortgage is a closed vault. Once you put extra money in by paying down your principal, you can't get it back out without refinancing or getting a home equity loan. Extra payments, they feel risky because that cash becomes untouchable equity that's locked in your house forever. One expert, they called it bluntly, they called it the mortgage prison. This lack of liquidity, it scares people away from paying off their mortgage and doing it in a faster way. And after all, life happens. You might need that cash for an emergency or an investment. Whatever it is, you can't get to that money. Number 4, one size fits all term. Nearly 90% of home loans are 30-year fully amortized loans, but one size does not fit all. Think about it. A 30-year term was invented in an era 100 years ago when people worked one stable job for decades. Today's world, much different. People move more, change jobs, have side hustles, start families later. Yet we're all squeezing into the same old mortgage mold. That outdated model can delay real financial security, and it doesn't adapt to life changes. Look, You're probably like something's hitting home right now for you. If you have a 30-year mortgage, you might be nodding your head going, yep, that's me. But here's the good news. You don't have to stick with this antiquated system anymore. It's time to challenge the norm and rethink what a mortgage should do for you. Introducing the all-in-one loan. It's a modern alternative. And what happens next, again, it could surprise you. All of those problems that we just listed, front-loaded interest, fixed payments, locked up equity, guess what? They're all being solved by an innovative mortgage called the all-in-one loan. Everything that we've been dreaming of, leveraging your income, paying principal first, adjusting payments automatically, and keeping access to your money, they already exist in this modern loan. So what is the all-in-one loan? In simple terms, it's a revolutionary home financing solution that combines your mortgage with your checking account. Imagine if every dollar in your bank account automatically went towards reducing your loan balance whenever you weren't using those funds. And it wouldn't prevent you from paying bills or withdrawing that money when it's needed. With the all-in-one loan, your paycheck deposits, your savings, all of your income, it immediately reduces your mortgage principal on a daily basis. This means you're not paying interest on money that's just sitting idle in a checking account. Instead, those dollars, they're working to cancel out interest every single day. Here's how the all-in-one loan flips the script on a regular conventional 30-year mortgage. First, principal first payments. Instead of interest first amortization like the 30-year, every payment you make and every deposit you make into your checking account, it goes towards reducing principal first. Interest is then calculated only on the remaining balance. After your income has sat against it, against the loan, it pays down that loan. From day one, you're attacking the principal aggressively, which accelerates the equity growth and shortens the life of your loan. You get out of debt years sooner and save a ton in interest, all without paying more each month. It's higher use of your income. Think about all the money that flows through your checking account over the years. This is an interesting stat here. Over just 5 to 7 years, the average person has more money pass through their checking account than what they owe on their entire balance of their mortgage. Crazy, right? But what most people don't realize is that money usually just sits in their checking account doing nothing before you spend it. The all-in-one loan, it takes advantage of this by temporarily parking your income against your loan balance. Every dollar of your paycheck that sits in your account, even if it's a few days or a few weeks, is lowering your loan balance and your interest in the meantime. This can dramatically reduce interest costs without requiring any change to your budget or your spending. You're not making extra payments, you're just using your existing money more efficiently. It's got automatic payment recasting. What does this word mean? What does it actually mean? This is a fancy way of saying your required payment actually shrinks automatically as you pay down the balance. In a modern all-in-one loan, when your balance goes down, the very next month, your minimum payment recalculates lower. It's built-in flexibility. If you get a bonus or just consistently reduce your balance, your required payment actually falls. It's easing your cash flow for the next time, the next time, and the next time. This creates a reward feedback loop. Every bit of extra money you park in the loan gives you an immediate benefit of smaller payments the next month. Contrast that with a 30-year fixed rate loan. You could pay extra for years and your payment, it never budges. With the all-in-one loan, the loan actively responds to your success. This can be a lifesaver during job changes, starting a family, or other big life events because you have the flexibility to pay less when you actually need to. It's an open-ended line of credit. It's liquidity for you. Remember that mortgage prison that we talked about? The all-in-one loan comes with a key that you maintain access to your equity as you pay it down. It functions as a first lien home equity line of credit combined with your mortgage. Every dollar you put in, you can take back out if you need to. This means you can confidently pay down your mortgage faster because you're not losing that liquidity. You're not losing your money. It's not gone forever into that prison, that vault of home equity. If you need funds for an emergency, an investment opportunity, or any reason whatsoever, you have 24/7 access to your funds without the hassle of refinancing. It actually aligns incentives for you. You're encouraged to pay off your loan faster because doing so doesn't handcuff your finances. In fact, it gives you more flexibility and a safety net. Liquidity is power in today's economy, and this modern structure, it provides that liquidity and that strength. In short, the all-in-one loan is designed to do what a mortgage should do: help you build wealth and freedom, not just keep you paying for 30 years. It's engineered, the all-in-one loan is engineered to reduce the total interest by tens or even hundreds of thousands of dollars. It's engineered to pay off a 30-year loan 2 to 4 times faster by using the same income. It's designed to improve your cash flow over time and provide liquidity for life's uncertainties. It's a path to true financial independence, not just home ownership. Look, there's a lot of benefits to the all-in-one loan, but let's bring this to life with some real examples. So this is a nice example that you can resonate with, right? A young couple, they basically saved $350,000 to buy a $600,000 home on a 30-year loan at 6.25%. They're looking at payments right just under $3,000 per month and 30 years of payments. But they only had about $1,000 left each month after expenses because their payment actually stayed the same. And paying the mortgage faster seemed impossible because they only had that extra $1,000 for other stuff. They opted for the all-in-one loan, and their starting monthly payment was about the same as a traditional loan, right around $3,000 in year one. But as they deposited paychecks and steadily reduced the balance, their required payment, it kept on dropping. So much so that it went to about $1,900 by year 5 and nearly $175, yes, $175 by year 15. Basically, just interest on a tiny remaining balance. They actually paid off their home completely in 14.5 years, less than half the time of a normal mortgage. And get this, they saved over $350,000 in interest compared to the 30-year fixed rate loan. All of this was achieved by the same income and budget just by using the all-in-one loan and its flexible structure to make their money work harder. By the end, their monthly cash flow had improved dramatically thanks to shrinking payments, giving them more breathing room for savings and real life expenses along the way. Here's another one. Let's talk about the low rate mortgages. Perhaps you're thinking, man, this sounds good if I have a high interest rate, but if I locked in a super low rate during the pandemic, I'm golden. Well, listen to this. A couple in Arizona had a 4.25% fixed rate, a very nice low rate. They were skeptical. Why would they give up their 4.25% for an all-in-one loan that might start out around 7%? What most people don't realize is that a lower rate doesn't always mean a cheaper loan. It's all about how much interest you pay overall and how long you pay it for. This couple, they tried an all-in-one loan simulation, and with their 4.25% 30-year mortgage, even if they paid an extra $500 every month in prepayments, it would still take over 26 years to pay off the loan. With the all-in-one loan, using that exact same income and no change in spending, they were projected to pay off their loan in 8.9 years. That's right, under 9 years versus the 26 plus years with extra payments on the regular traditional loan. The all-in-one loan, it didn't require them to scrimp harder or to send in extra money every single month with iron discipline. In fact, only about 4% Americans can actually keep up consistent extra mortgage payments over a long period of time. So this simply automated the process of putting their income to work. As their balance fell, their required payments actually dropped, freeing up more cash flow each year. They maintained full access to their funds for any emergencies that they might have. And in the end, the higher rate all-in-one loan would have cost them far less because they eliminated 20 plus years of interest payments. In fact, the analysis showed that for them, it would be like having an effective interest rate of, guess what? An effective interest rate of only 1.5% on their mortgage. And that's thanks to all the interest that they saved. Talk about a huge surprise. Look, the takeaway, a mortgage that prioritizes principal reduction and time saved can have a bigger impact on your cost than a lower interest rate. These examples, they show that the all-in-one loan isn't just theory. It's working in the real world for real people. It's not magic. It's just a smarter design. And by recasting payments as the balance drops, giving you a lower bill each month as a reward, it motivates you and eases your budget. By keeping your money liquid, it removes the fear of what do I need the money for? When do I need it? And by leveraging your income and making every dollar count, it achieves results that would normally require sending double payments to the bank. How many people do you think can sustain double payments each month? Well, I know there's a lot of skepticism here. Why haven't I heard of this mortgage before? Well, it's not a secret. I know that this is so great. Why isn't everyone doing it? Why haven't I heard about the all-in-one loan before? It's a great question. The all-in-one loan, it's actually been around since 2005, but it's not offered by most big banks. Why? Because it fundamentally changes the 30-year status quo that banks profit from. Banks want you paying interest for 30 years. Guess what? That's how they make their money. The all-in-one loan, it turns that model on its head by helping you cut down interest and paying off your loan faster. It's a product that's pioneered by innovators like our owner at CMG Financial, who created this loan back in 2005. And it's gradually spreading as more people demanded a smarter way. But you'll rarely see a big bank advertising, pay off your mortgage in half the amount of time. It's just not for them. It's not in their best interest. No pun intended, or actually pun intended. Another concern, isn't the all-in-one loan a variable rate interest? What if the rates go up? Yep, it's true. The all-in-one loan is typically a first lien home equity line of credit, which often has a variable rate. However, as we saw, rate isn't the only factor in your mortgage cost. By drastically shortening the loan's lifespan and principal, the all-in-one loan can come out ahead even if its rate is higher at times. Plus, you're in control if rates rise. You benefit even more from paying the balance down faster, and you can always adjust how much you leave in the account to minimize that interest cost. Many all-in-one users find they effectively beat their old low-rate loans because they stop paying interest after a decade instead of 3 decades. In one analysis, the break-even rate would have to have skyrocketed to over 10% for the all-in-one loan not to save that couple money versus their 4.25% loan. In other words, as long as your all-in-one loan's average rate stays below some very high threshold, 10% in that case, you're winning. And historically, few people keep a single mortgage for 30 years anyways. But instead of refinancing and resetting the clock, the all-in-one loan lets you keep making progress. The key point here is it's not only about chasing interest rates, it's about changing the game. It uses the money you already earned to work for you in reducing debt automatically and efficiently. No extra sacrifices, no strict budgeting plan required, just a smarter structure. It's almost like a set it and forget it and let your normal income and spending patterns accelerate your mortgage payoff. I know, I've done it. I have this loan. It is a new mindset. It empowers your financial future by with excitement and curiosity. It's so good. The goal of this video is to really open your mind to the possibility that the 30-year mortgage isn't the one and only path to home ownership. There is a better way to finance your home that aligns with your financial goals instead of working against them. Imagine the peace of mind of being mortgage-free years earlier than you thought possible, or the confidence that comes from knowing that every dollar you earn is pulling double duty, providing for today's needs and slashing years of interest off your loan. The all-in-one loan is about empowering you. It's about giving you control to shape your mortgage around your life rather than controlling your life around your mortgage. As one industry white paper put it, if you're ready to break free from the outdated mortgage structures and make your money work harder for you every single day, the all-in-one loan is your opportunity to do exactly that. Why settle for status quo when a better option is on the table? Look, here's the deal. Have you ever wondered what your life would look like beyond your 30-year mortgage model? If it took you 30, 40, 50 years to pay off your house, what would it look like? Hopefully, now you have a better glimpse of it. We've seen how the old way is failing many of us, keeping us in debt longer, siphoning off our hard-earned money in interest, and restricting our financial flexibility. And we've seen that the all-in-one loan offers a proven, practical alternative, a way to build equity faster, a way to save money, a way to stay liquid at all times. It's time to rethink mortgages and demand more from your home loan. If this got you thinking, I need to learn more about this, then do 3 things right now. 1, like this video. Subscribe to our channel for more eye-opening insights, and share this video with anyone that you know has a mortgage or is about ready to get one. Let's spread the knowledge. Believe me, your friends and your family, they will thank you for telling them about this better way. And finally, if you're curious about the all-in-one loan and how it might work for you in your situation, you can click the link in the description right now, and it'll take you to a resource where you can get more information, more details. And even if you want to run the simulator on your own numbers, I can do that for you. As a special thank you for watching this and taking action, we're actually giving you $250 in credit towards your next closing costs on this loan if you decide to move forward with this all-in-one loan. Look, I know this is a lot to take in. There's a lot of questions that you might have with this, but it's exploring a smarter financial future. Don't let the 30-year mortgage keep failing you. Take control and make the money work for you, and join the growing number of savvy homeowners who refuse to be stuck in the past. Remember, the right words can influence your mindset, and if the right mortgage can transform your financial life, what happens next might surprise you. So call me today and we can walk through the numbers with you. Thanks for watching, and we'll see you in the next video.